Hi everybody, this is Edward, your favorite homeboy, and today our special guest is John Rubino with JID Investments.
How you guys doing? Happy to be here. Thanks for having me.
You bet. Today you really want to listen to the end of this video because John Rubino is going to show us some really cool ways to invest in real estate that you probably never even heard of. Most of the times I'm investing in real estate, I have to save up for a big down payment, I have to pay those pesky closing costs, I have to wait a while for the money to get high enough where I can sell it, do a 1031 and get a good return. But John Rubino has a really cool method where you can invest in real estate, actual real estate that you can touch and feel, and over a 3 to 5 year time period, get about a 15 to 20% annual return. So before we get started, John, is it gonna be coffee or cocktails?
Oh, coffee.
Coffee. I'm glad he said that because Joey's falling asleep and he needs a coffee too, our videographer. So we're gonna make some Vietnamese coffee because we just had some Vietnamese food. It'll go great with that. So let's get started. All right, well, let's get started.
Yeah.
Hey,
definitely.
John, it's good to have you.
Thank you so much. Good to see you again, my friend.
Yeah.
Yeah, this is a treat.
Well, let's start off, John, by telling the audience just kind of how you got started and what is it you do, JID Investments. What is this all about?
Well, I'm a 20-year Navy vet. I know you're Army. I won't hold that against you. But I did 20 years in the Navy. I was a pilot. I flew P-3 Orions. We were submarine hunters, which was cool.
Wow.
And so I did that for 20 years. I was an instructor pilot for 4 years out of the 20. Got some service time as a staff officer. And so I got to see a lot of different things. I got to experience a lot of different things in the military. Grateful for my service. Joined in 1997 out of college, and in 2004, 2005, I was stationed down in Southern Maryland.
All right.
And I had a mentor at the time, a good friend of mine, really good friend, who started getting into real estate. Started talking about this thing called real estate. I was like, "What's real estate? Go buy a house, or do you need a real estate agent?" And he started talking about, hey, I want to invest. I want to go buy property. I want to fix stuff up. And I was just listening to him. I guess God is good. He put us together at this tour after this one where we were together in Florida, where we were talking about this. And when we were in Maryland together, in Southern Maryland, he started telling me more about it, and I started catching on and saying, this is really cool. I want to learn more about this. So I started to actively invest, and I started to look at getting into real estate, buying property, fixing property up, selling property, and seeing what the rewards were to that. You start out with your bumps and bruises, you learn, but we eventually got into new construction properties, and we connected with a local area builder, and we started doing 1 or 2 properties each. And so the first one I did, I bought. We did it under a construction loan. The builder built the house, and then we get done, and the day the house is done, I sell it the next day.
Wow, the market was good enough to do that.
I make a $60,000 profit.
Wow.
I'm like, okay,
I like that.
I'm in.
Repeat.
So then I did 2 more of those right before the recession hit in 2008, 2007. And my buddy and I kind of went in 2 different directions. He decided, hey, I'm going to get out, and I'm going to go hit DC up, and I want to build my business. And I said, well, I'm going to stay in with my family. I'm going to keep serving. So we kind of broke off, but I gave him a nice chunk of money, and I said, look, you helped me get here. This has been a gift because of you, and what could you do with this? And he said, well, I could give you a fixed return for 7 years. And so that's what we did. And he started growing his company. And as he grew his business with my investment capital helping that, he was sending me packages on projects, due diligence, demographics, budgets, plans, permitting, all of this stuff. And so now I'm learning this. And I'm getting involved in it.
Digesting all that information.
So fast forward now to 2010, 2011, I moved back to Washington, D.C. after a 3-year tour in Texas as an instructor pilot, and I got orders to the Pentagon. And I'm at the Pentagon. I get through the first year, and I survive. And I'm at 2012 now, and I'm saying, well, I'm going to retire in 5 years. What's next? Do I want to go out and be a contractor? Do I want to be a Beltway bandit? Or do I want to be a government employee? And I said, yeah, I'd really just like to try something on my own. So I got with some very smart people, which I think has been a blessing, to get around people that are a lot smarter than me. And I started asking, like, hey, I'm interested in entrepreneurship. I want to start my own company. And I thought to myself, well, heck, I've done this model for the last 7 years with my buddy. Why don't I expand this and make this a business? And that's how it took off. And so I talked to my accountant, who's my best friend and now my business partner. And together we spent the full year putting this idea together, building the website, putting our company documentation together, getting all the legal docs, learning what it is to be a business. And after that year, we thought we were ready to go, and we gave our paperwork to some very, very trusted, experienced people in the industry in banking, mortgaging, real estate that had 20, 30, 40 years, and they beat the heck out of us, which was great.
Asking you all the hard questions,
said all the hard questions. They made our paperwork better, our documents, and they gave it back to us. And when we went to take it back, they were holding on to it pretty tight, and they said, make sure we're your first investors. We were like, wow, what a blessing. So we started out very small.
So in a nutshell, what was the basic business idea?
The idea was that we wanted to take our money, my partner and I, and we wanted to work with friends and family first. People that I knew in the military. He has an accounting firm, so his close clients that had interest. And we wanted to take the money and pool it together to then invest out to developers and real estate partners and sponsors that needed the capital for their projects. And so we started first giving them 100% of the money if the numbers made sense and the returns were within our target. And we were funding 100% of the project, and we were getting wonderful returns. We were making 12% over 6 months, 20% over 8 months. And we started doing that, but then money started getting cheaper. People were going to banks and hard money lenders. So then we kind of found our sweet spot, which has been equity or private money. So you go and buy a home. You need to get money from a bank. And the bank's going to give you between 50 to 75% of the money you need to buy your home. Cheap money. Cheap money, long term, 30-year fixed, whatever it is, at 3 to 5 or 6%. Right? But they say you need to bring in the other 50
you need to have some skin in the game.
You need to have skin in the game. So the businesses that are going out and getting these multi-million-dollar loans still need to go out and get multi-million-dollar investment capital as down payment in order to get that capital and be able to do the project for 100% of their cost. So what can they go to for a company that they need 25%, let's say, on a $50 million loan? They come to a company like me, and I can go out and I can raise that money from a pool of investors. We have about 130 investors now. And we raise that on a project-by-project basis. And my partner David and I, we're kind of the liaison or the conduit between the developer and the sponsor whom we've grown a relationship with. We've done the due diligence on. We've checked them out to make sure that they're a good company and they have good performance. And then we take, after we approve them for funding and then we start looking at their projects, we then go to our investors and we bring those projects to our investors and introduce those to the investors to have the opportunity, not requirement or obligation to invest, but just have the opportunity to invest.
So now you let the banks provide the cheap money and you guys provide the money that they'd have to otherwise come up out of pocket.
That's right. And for that, it's a premium. You know, we offer our money, you know, could be high 20s to low 30s annualized on our return. So let's say we make 30% a year on a development construction project. That's a 3-year project, and we bring in $3 million. Well, in 3 years, we're making $900,000 a year on the $3 million. So we're making $2.7 million on the $3 million after 3 years. And we take that and we break that out and we give 60% of that to the investors, and the company keeps 40%. So we want to give the investors the bigger chunk of those profits because they're taking on the same risk we are as investors, but we always want to make sure that we take care of the investors first, get them back their money, get them their returns, and then we take our profits. So we've been very successful. We've had a lot of success. We've done about $6.5 million in investment over the last 6 years.
Projects is that about?
16 projects.
Oh, 16 projects.
We've had 16 projects complete over a 7-year period that we've completed, and we've earned about $2.25 million in revenue. Right now, we're investing on 6 projects with $14.5 million in investment, with about 12 to 15 million projected in revenue.
So about on average, these projects, tell us about these projects. How do they look like? What could they be, hotels or apartments? Or what
typically we break it up into, we call it alternative investments. So we have development and construction. We buy, the sponsor buys a piece of land. They have to get it developed, they have to get it entitled, they have to get the permits, right? So we go through that process, which we call the horizontal. And then when they get the permits in hand, they're going to build the property or the vertical. We can come in any phase of that project, and it all depends on where we come in. that will then dictate our returns. So the earlier we come into the project, the more risk, we're going to get the higher yields. We come in the middle, maybe
more developed, less risk,
exactly,
and less return.
Other type of projects we come in on are multifamily, stabilized apartment assets, where we're making an actual return, we're paying out cash flow. On the previous projects, we defer the gains because we're usually exiting the project where it's a sale of the building or a sale of condos. So we have to wait till the bank gets paid, and then we get paid after that. The bank's getting paid first. But on a cash flowing project, we'll get paid cash flow on a quarterly or semi-annual basis, typically 7-8%.
When you say cash flowing project, is this a project that's already built out?
Yeah, it's stabilized, it has tenants, and the sponsor's coming in and doing what's called value add.
Maybe like renovations or something like that?
They're doing rehabs and renovations.
Got it.
And they're improving the property management, the cost structure to increase net operating income, kind of your world in property management. And they're updating the units to make them more modern so that they can get higher rents.
I see.
So in turn, they're taking the asset that maybe was making about 60% of the ideal returns or the revenue to now 100% based on improvements in management and in renovation. So those were making about 8% a year.
Cash flowing properties, and it's less risk, less return. What about if it's a condo that's doing pre-sales? Do they have to pay back their mortgage first, and then after enough pre-sales come, then you
we call that the capital stack. So in the capital stack, the bank's always going to be batting first in the batting order. Then you'll either have an institutional equity lender, or you'll have somebody like us that's batting second, which we're called private or common equity. And so we're batting a lower in the order. So in return, we're getting higher returns. We have more risk, obviously. But at the end of the day, on those types of projects, we're making 20 to 30% annualized on our numbers.
Sign me up, John.
High yields, but high returns, a little higher risk. But it really depends on the investor's appetite. What's your desire for exposure to risk? Do you want to be on something that's a little riskier? Do you want to be on something that's a little more conservative? Where we are in the economy? So those are the things we think.
What's your track record then? So if I'm going to invest with you, what's the chances of me losing my money?
It's a great question. I mean, there's a chance you could. That's the worst thing that could happen is you lose all your money. Because if we have a correction, the bank comes in and reevaluates the valuation of the property and says, hey, you know what, Mr. Sponsor, I know it was worth $10 million you went to loan, but now it's worth $5 million. So now we have to make the loan, we have to correct the loan. So then our capital is exposed. So how do we combat that? The first thing we look at is the developer's experience, their track record. Second is, where's it located? Where's the location? Huge. Where's the location? Third is, what's the risks? What are the other risks? You know, is it timeline risk? Is it development risk? Is it weather? You know, all the different things we look at. We look at the returns. And then again, the timeline. I don't want to get into a 60-month project right now where we're starting from scratch, given where we are on the real estate cycle. I'd rather be in something where we're going to be building and we're in and out maybe 2 or 3 years.
That makes sense.
So those are all the things we think about.
So if I want to get started right now, what's the barrier to entry?
So I want to get you on board and get comfortable with our process. I'm going to collect this from you on day one when you become an investor with us. We don't want any of your money up front. We just want you to get comfortable with us. We want you to get comfortable with our process, understand what we do. Ask me questions, come out to the project site, get to know me, have a conversation with me with a great cup of coffee, and really understand our process. And then when you get to that point where you say, hey, you know, John seems like a good guy, he's got a great track record, I like what I see he's doing, I want to become an investor, we go through a vetting process. Typically with our types of investments, it's not open to the general public. Someone from Morgan Stanley or from Edward Jones can't come and invest with us right off the blue. You have to meet certain criteria. You have to be what's called an accredited investor. You have to meet certain net worth or income levels in order to invest with us. We do have close friends and family that don't meet those parameters, but they're called sophisticated investors, meaning they can understand. They're not investing their mortgage or their rent money.
Is that a matter of just signing something saying,
yes,
hey,
we have a questionnaire. We have you fill that out. It has all the details of the risk and everything. And at that point, we do some verification to make sure that you meet the parameters, and then you become an investor. And at that point, I can send all the project-sensitive information to you because we have non-disclosure agreements with these businesses. So we're sending you all of these project packages when we have them, and then you have the option to decide whether or not you want to invest.
Okay. So basically you're telling me you either have to be sophisticated or have money.
Or, you know, you have a net worth that's over $1 million, not including your beautiful home like this. You know, it's not your primary residence.
All right.
Right. So, and that's all stipulated, and you can find that information. We're happy to provide that as well.
Cool.
Yeah.
All right. Anything else you can tell us?
Well, I could tell you that real estate's still booming.
Yeah.
And it's doing really well, especially in our local area here in DC.
What are you guys looking at next? Like, what's the hot thing now? Like,
You know,
what do you think that's going to perform really well?
I don't want to be in venues where it's oversaturated. Right now, I feel multifamily is getting very saturated. So what are we looking at? Opportunity zone, senior assisted living, car washes.
Car washes.
We're looking at different things that a lot of people aren't in. And opportunity zones are exciting. You know, just a quick 10 seconds. It just gives you an opportunity to take deferred gains as a passive investor and bring those into a project. One of the things I didn't mention too is when you invest with us, it allows you to bring in a level of capital, usually between 25 to 50,000, and you can participate in a large investment as a smaller owner. So as a $25,000 to $50,000 investor, you can come in on a $3 million project.
Right.
And that's exciting.
Yeah, you can say, hey, I have a piece of that.
You have a piece of ownership. That's right. That's exciting. So we're looking at opportunity zone. We're looking at assisted living. I mean, baby boomers, they're retiring now.
Yeah,
they have tons of capital that they could put into better quality of life and living in developments that can assist what they need.
Cool. Hey, man.
So that's it.
This is great. Great information.
I appreciate it.
Hey, if you're watching this interview, make sure to drop any questions in the comments below for John and myself, and we'll be sure to get back to you on that. Don't forget to subscribe to the channel and share this video with anyone you know that might be interested. Again, this is your favorite homeboy, Edward, signing out.